3 things just happened in the last 24 hours that confirm everything I've been telling you on this channel. And a 4th thing happened that the financial media is completely ignoring. By the time you finish this video, you're going to understand why gold just bounced back to $5,000, why silver is recovering to 78, and why the next move could be the biggest one yet. First, the United States government just confirmed a price floor system for critical minerals, including silver. Second, Hecla Mining, the largest silver producer in North America, just reported their fuller results. And buried inside those numbers is a detail that proves industrial buyers are bypassing comics and paying 30% more to buy silver directly from mines. Third, the CEO of APMEX, the largest online precious metals dealer in America, just published a letter saying shipping times are finally back to normal after a full month of delays. And fourth, there are currently 35,000 call options on March COMEX silver futures that are in the money right now. And the banks cannot do anything about it, even after crashing silver 46%. Let me show you why these 4 stories together are the most bullish signal for silver I've seen since this entire cycle started. And I'm going to be honest with you, when I saw all 4 of these hit within the same 24 hours, I almost couldn't believe the timing. Hey, James here. This is Noble Metals. If you're new here, subscribe and drop your locatio. Where are you from? And share your thoughts in comment section. The most significant development comes directly from Washington. The United States has officially developed a critical minerals price floor system and is actively presenting it to allied nations. This was confirmed publicly by Undersecretary of State for Economic Affairs Jacob Hellberg. But the groundwork began earlier. On February 4th, Vice President J.D. Vance addressed representatives from 55 countries at the State Department's Critical Minerals Ministerial. He stated that the U.S. would establish reference prices at every stage of production, and that these prices would function as a floor maintained through adjustable tariffs. That means critical minerals, including silver, will not be allowed to fall below a certain threshold within the participating trade bloc. This is not speculation. It is formal policy direction. The European Union, Japan, Mexico, and 11 additional countries have signed bilateral agreements supporting this framework. On that same day, another layer was added. A $12 billion strategic reserve initiative called Project Vault was unveiled, backed by $10 billion from the U.S. Export-Import Bank and $2 billion in private capital. The objective is clear: stockpile strategic minerals and stabilize prices. When you combine a government-supported reserve with a tariff-enforced price floor, the implication is enormous. The United States is effectively signaling that the current market price of critical minerals is too low to sustain domestic supply chains. In other words, the market is broken. For silver specifically, this is transformative. A government-backed floor changes risk perception for miners, industrial buyers, and investors alike. It converts volatility into strategic backing, and notably, this announcement occurred while silver was trading near $74 after collapsing from $121 during the sharp January crash. This policy shift is also a response to China's tightening grip on mineral processing and export controls. China has reclassified silver under strategic material guidelines and licensed dozens of companies under stricter export regime. The West's countermeasure is price support rather than supply restriction. China is limiting outflow. The U.S. is guaranteeing value. Both forces point upward for price over time. Silver is no longer being treated as a simple commodity. It is being treated as a strategic national security asset. It is embedded in advanced weapon systems, solar panels, semiconductors, and nearly every modern industrial application. Section 232 investigations have already concluded that reliance on processed mineral imports threatens national security. That designation alone redefines silver's role in global trade. While policy was shifting, corporate earnings delivered confirmation from the supply side. Hecla Mining reported full-year 2025 results that were extraordinary. Revenue exceeded $1.4 billion. Up 53% year-over-year. Net income reached $321 million, 9 times higher than the previous year. The strongest financial performance in the company's 135-year history occurred during a year many claimed the silver rally had failed. This matters because miners operate at the source of supply. They experience real transaction pricing, not just exchange benchmarks. When a miner's profitability expands at this magnitude, it signals repricing at the production level. The most revealing detail in Hecla's report was pricing. The average benchmark silver price during Q4 was approximately $54.83. Hekla's realized price was $69.28, nearly a 30% premium. That is not theoretical. That is audited financial reporting. Either the company times sales perfectly, or buyers are paying substantial premiums directly to secure physical metal. Given similar reports of Shanghai trading at premiums and London lease rates spiking to extreme levels, the second explanation carries weight. Industrial buyers appear willing to bypass exchange pricing to secure guaranteed supply. That divergence between paper pricing and realized physical pricing suggests structural strain. Hekla's forward guidance strengthens the signal. The company is selling a gold asset for nearly $600 million to concentrate more heavily on silver production. This strategic reallocation occurred while gold trades near $5,000. That decision implies internal confidence in silver's upside potential. Production guidance for 2026 targets up to 16.5 million ounces, while exploration spending nearly doubles. All-in sustaining costs remain around $18 per ounce, generating enormous margins at current realized prices. One flagship mine reported negative cash costs after byproduct credits. When producers expand aggressively under these conditions, it indicates belief in sustained higher pricing. Demand-side stress was confirmed by APMEX, the largest online precious metals retailer in the United States. Its CEO acknowledged that shipping delays lasted nearly a month during the recent volatility. Order volume surged to 7 times normal weekend levels. Inventory narrowed to a limited selection of core products. Customer service staffing expanded by 25% to manage demand. The letter announcing a return to normal shipping implicitly confirms that the dealer infrastructure was temporarily overwhelmed. That type of disruption does not occur in balanced markets. It occurs when physical demand exceeds logistical capacity. The timing of normalization is equally important. The crash on January 30th temporarily cooled demand, allowing backlog clearance within approximately 18 days. But if prices continue recovering, renewed demand could recreate supply pressure. Structural deficits have not been resolved. COMEX registered inventory remains near 98 million ounces. Shanghai premiums persist. Industrial offtake agreements remain active. The underlying tightness did not disappear. It paused. The fourth critical factor involves options positioning. Roughly 35,000 March silver call options are currently in the money. Each contract represents 5,000 ounces. If exercised, that equates to potential demand for 175 million ounces, far exceeding registered inventory levels. Historically, price suppression into expiration attempts to neutralize such exposure. Yet, even after the 46% crash, a substantial number remain profitable. Not all option holders will exercise for delivery. Most close for cash settlement. However, in an environment where physical silver trades at premiums above futures pricing, incentives change. Arbitrage becomes attractive. Exercising futures at $78 and selling physical at significantly higher levels generates opportunity. That possibility alone pressures exchange inventory assumptions. When these four developments are viewed together: government price floors, minor pricing premiums, dealer shipping disruptions, and in-the-money call concentration, a coherent pattern emerges. Policy support, supply-side confirmation, retail strain, and derivatives positioning all converge toward one conclusion: the physical market is exerting pressure on the paper pricing mechanism. Gold's recovery to $5,000 reinforces the broader metals narrative. The rebound pattern resembles engineered volatility rather than speculative collapse. Silver's steady grind higher after a violent drop suggests underlying accumulation rather than capitulation. Structural deficits, policy backing, and corporate investment point toward repricing rather than exhaustion. The conclusion is not hype but synthesis. A U.S. back price floor changes long-term downside assumptions. Miners realizing 30% premiums confirm physical divergence. Dealer backlogs prove demand stress. And 35,000 inches. The money calls introduce potential delivery pressure into an already tight vault structure. Whether prices surge immediately or grind higher gradually, the structural forces appear aligned. Silver is being repositioned from volatile commodity to strategic asset. And once a government constructs a floor beneath the market, it alters the psychology of everyone participating in it. I'm not here to build a cult of followers. I'm here to build a community of thinkers. At Noble Metals, I provide the raw data, but I want you to bring the hard questions. We live in an era where debt is sold as wealth and clicks are sold as value. Don't just take my word for it. I encourage you to be a skeptic. Check my sources, challenge the mainstream narrative, and verify every claim I make, because at the end of the day, a truth you've discovered for yourself is far more valuable than any hype or financial trend. Real gold is rare, but real truth is rare. Let's find it together. This is Noble Metals. I'll see you in the next